Hi guys, welcome to my video number 7 here on my YouTube channel. As you may see, I have invested in a Blue Yeti microphone, so hopefully the sound quality will at least be quite good this time. I'm yet to invest in a camera, but the feedback was that the video quality was okay in terms of the actual camera. So I started out with a microphone, and hopefully this will improve the sound experience significantly for you guys. So video number 7 as mentioned, and today I want to go a bit more personal and talk about my story and how I ended up becoming an investor on the stock market. What was my motivation to get started? How did I get to where I am today? Talk a little bit about my motivation and also about my end game. I'm receiving quite a few questions regarding both how you as an early investor in the market, what are the things you need to understand, what are the books you should read, what are the videos you should see, and so on and so forth. So loads of these questions, but I think actually a question that is more interesting is the motivation. What is the why of investing in the stock market? And of course the easy one is simply to say I want to increase my wealth, but there needs to be more behind the rationale of investing, at least from my perspective. Otherwise you will not get the goals that you, or get the returns that you're interested in. So first of all, let's do a short I'll try and keep it as short as possible, a history, or at least some background knowledge about myself. So as you may know, at this point in time, I'm 23 years old. I'm working as a management consultant at EY Parthenon, and has been doing so for 1.5 years. I hold a bachelor degree in international business from Copenhagen Business School, and my investment journey started back in 2015. So that is a little more than 5.5 years ago. I started my journey, and to get the background for why I started investing. So at that point in time, I went to high school, and I went to what we in Denmark call HHX, which is sort of the financial or economic path of high school back here in Denmark. My parents have a sort of a classical office background. They both have a job as a salary director, so to say, and that's my mom, and my dad is working for a telco company. None of them are in significant positions whatsoever. So my drive is definitely not coming from them. However, my granddad has been sort of introducing me to the stock market since I was very, very little and very young, and that sort of initiated, or at least started the fire inside me. When I was 17 or so, 16, 17, I started simulating a portfolio in Excel, simply creating a portfolio, a simulator, buying virtually some companies, putting them in a portfolio, and then tracking their performance in an Excel sheet. And of course it's a nice way of sort of getting to know the market, getting to know the dynamics, or at least see how things are going up and down. However, it never really gets real when you're simulating, whether that is on eToro or plus 500 or whatever. You simply need to get your head in the game, so to say, or at least put some money in it in order to feel the emotions, feel the dynamics on your own body and your own mind, to actually get to a place where you feel comfortable, or I would rather say the opposite, not feel comfortable with your decisions, being vulnerable, being uncertain, and then being sort of in a position where you need to be comfortable with your decisions, doing your own analysis on investments, unless you are sort of going the easy way forward and simply investing in indices following the market, so to say. And I'm a huge recommender of doing that, and my own pension is positioned in indices. But I think if you have an interest for the market, if you have an interest in doing analysis and providing a return, and that return may not sort of outperforming the market, but you get a feeling, you get an adrenaline for actually being in the market. And I think even though I may not be able to outperform the market every single year, I would rather spend 40-80 hours a week analyzing stocks on the side of my day job, and get that feeling and sort of increasing my knowledge, increasing my understanding of the market, than I would simply live my everyday life and then simply invest in indices. And that is sort of that is a choice you need to make, and nobody says you need to be 100% allocated in stock picking. Nobody says you need to be 100% allocated in indices. So that is simply a strategy or a decision-making process you need to go through when you start and you start investing in the market. Back to my early days, and I simulated for, I think it was half a year or a year or so, and then I put some money in the market, and actually it wasn't my own money. And you can say, well, will that provide you with the same feeling of actually putting your money out there and get that feeling? And was my parents' money. My parents sort of invested into me, and that was a great trust they put in me back then. Started out with quite some small figures, but as we got along, it became quite significant money they invested into the portfolio. I started out with 20,000 Danish kroner, which is approximately what, $3,500 US, and I invested that in quite passive companies, quite large companies like Novo Nordisk, Genmab, and after a month or so, I think I made 1% or 200 kroner in return, and simply it didn't really fulfill my adrenaline. And of course, as a former gambler, and of course also that is being extremely dangerous to pull that into the market, because you will look for that excitement, that adrenaline that you will get from trading. And I think I have also been there throughout my 5.5 years on the market. I have also ended up in corners where I tried to force that feeling of adrenaline, trying to force that quick money feeling of being in the market, and it's not. People can do that, and I think there is a rule of thumb that 90 or 99 or 98% of those that are day trading are profitable, but the remaining 99 or 98% are not profitable. The remaining 1 or 2% are able to actually make a buck on day trading. And I think if you have an edge in that and you have the time, then okay, fine. But even myself, that I feel I'm quite capable and quite competent in the market, I have had a difficult time when I started moving into that trading perspective and trading mindset. But to get back to the story, I only invested in those large cap companies, some of the index companies, for more than 3 months or so. Then I sort of flipped and pivoted in terms of my strategy, and I started investing in small cap companies, especially in Scandinavian small cap companies. And in some of my previous videos, I've talked a little bit about this, and also with Interfox Resources being one of the worst investments ever. The reasons for that being I didn't do any due diligence myself. I simply followed people blindly through their posts on social media and so on and so forth. So the first period on the stock market for myself was extremely learningful, but also extremely tough, because I didn't really create a return. I made all of the mistakes that you're able to do or able to make as an early stage investor in the stock market. So I think from that perspective, I probably went through a phase there where I made all the mistakes, which were fine because I learned from them. I sort of journal things. I started to noting my decision making, and that sort of put me in a position where I developed. I created a learning curve for myself that was quite steep. But sort of how I started was quite. It wasn't really me sitting down reading tons of books and listening to podcasts, stuff like that. It was me becoming autodidact in terms of learning myself by doing to a great extent. What I did quite early on was that I contacted one of those administrators of one of the Facebook groups in Denmark covering stocks and investing, and asked them if I could do some analysis of the market on a daily basis and post it in the group. So I did that, and for quite a long period of time I started out by doing these, I think it was 1,000-1,200 words analysis of the overall market, macroeconomics. How did the Danish market develop throughout the day? How did the European market develop throughout the day? How did the Asian and the American market develop? How did macroeconomic figures and sort of perspectives on the market influence the market, and sort of understanding those dynamics? And I spent quite some time on it. I think I did that for maybe half a year or so, on a daily basis, actually creating these analyses, following the market quite intensely while I was in high school, and sort of moving on from there to also investing individual companies, individual stocks, to understand what are the aspects of fundamental analysis in terms of what are the parameters you want to look into, how you're able to actually analyze whether a company will be successful or not. And by doing that, I sort of developed a strategy that wasn't really a strategy, but I got an understanding of the market. And I think your strategy, and I tweeted this the other day, your strategy will never be final. You will never end up in a place where you think, now I have refined my strategy to an extent where I'm not able to actually progress anymore. If you say that to yourself, you will for sure stagnate, and at some point you will not be able to perform well. You will not be able to outperform the market, at least from my perspective. And of course, at some point you will also get to a place where I think, okay, I'm quite comfortable with where I am right now, and that's fine. But I think always trying to learn more, always trying to get input to your strategy is extremely valuable. And I think 80% of your time in the stock market should be about researching, whether it's about individual stocks in your portfolio, new potential candidates for your portfolio, or whether it's about simply understanding the market. I think 80% of your time should be about that, and the remaining 20% should be following your portfolio and sort of monitoring things in the market. So I think around 2018, I joined a national radio program in Denmark called Millionaire Club, and that sort of became my breakthrough in terms of really setting aside time to even dig deeper into the market. I got a portfolio, only a small portfolio relative to the other contestants in the radio program. It was a competition of creating the highest return over the course of a year. But it really made me deep dive on specific companies, specific industries, and even though some of the investments I made in there didn't turn out well, Patriot One Technologies, we all remember that company and that stock. I created a significant return on it during my time in the program, and also earned quite a buck on it myself. But in the end, it has ended out as a terrible investment. It's around all-time low levels. However, I ended up second in the competition of 4 participants in 2018 with the portfolio, and it sort of provided me a name, and also quite a few of you that are following me on Twitter and following me here on YouTube knows me for that program. And I think it also made me understand that all perspective you get from outsiders are great, but you also need a filter on understanding what is good for me, what fits my strategy, my mentality. And several of the people in Millionaire Club, and also guest participants have a completely different perspective on the market. Tom Horgård, who is a day trader, he trades currency, he trades indices, and he does it with leverage. A great guy that has been a former trader on Wall Street or in London for the sake of him. Then you have Lars Svensson, who is a fundamental analysis kind of guy that is simply buy a company, put it in the drawer, and then have a look at it in 5 years. And sort of, he has some industries that he's just following every year and just invest in every year, and sort of trying to get an edge around that. And some people may call him outdated. I would say that he's just, that is just his turf, so to say. And getting a turf is fine, but I think it also, to some extent, stagnates you again, because you don't really develop from that stage, and you will invest in the same companies in the same industry instead of sort of widening your perspective and sort of looking at the world developing. And I think Lau was maybe not that good at that. And then you have Lars Persson that is very focused on technical analysis, but also with a tweak of fundamentals in there, kind of a momentum trader. And he's very very happy for the Swedish market. And then you have Christopher Wall, who is very much a technical trader, only looking at Elliott wave and looking at the graphs in the market. So you have several people, and at that point in time, I was a bit honored of being part of the program. That also made me more sensitive to the input in terms of actually sucking it all in and sort of trying to really test different things in my strategy, and that ended up quite poorly actually, for the money that I tried those elements on, trying to trade, trying to sort of jump back and forth between positions, trying to follow people on Twitter and simply following them without doing my own analysis. And I sort of went through in those years, 2018, 2019, I sort of went through this phase of trying to form and shape my strategy. And I think going through all of these periods where you simply make mistakes is a healthy thing, because it also makes you understand that what is it you want to do, and what is it that needs to become your edge. And I think following people blindly and copy trading is not a way to go, because first of all, especially on Twitter, people will post their entries and they will try and hype stocks based on that, but they will also not tell you when they exit the stock. If things go down the drain, they will likely not even tweet about the company or the stock once again. So if you want to be truthful to yourself, then you need to do your own due diligence. And as I've said many times, you need to find sources of inspiration. And I have a lot of people that are sources of inspiration, but I never just follow people blindly. Yes, Mads Christiansen, for instance, in Millionærklubben, who created a tremendous return last year, and an extremely competent guy who has an edge in sort of doing fundamental analysis, but not really, because he only sort of have a perspective on some of the elements in a fundamental analysis. But he's so competent. I would never follow him one-to-one in terms of just copying his portfolio, because even though he sees things, I may see things differently. And I think everybody can, with a one-liner, sell you companies. And I think that is also a sort of a learning for myself, is that if you need to only sort of pitch a stock on a one-liner, it's extremely easy to make it sound more interesting, more exciting than it actually is. And you need to be aware of that, because many companies may on the surface look extremely exciting and attractive, but when you get down and sort of that visualization of having a mountain or an ice block where only 10% is above the surface, 90% is below, and that will also be the case when you're sort of deep diving into companies. What may seem to be an extremely attractive investment above surface may be shit. And I think I've tried it several times. Interfocus Resources is one example, FT Networks is another example. Maybe even Patriot One Technology is an extremely attractive technology on the surface. What seemed to be a extremely competent and experienced management team ended up being very poor at communicating, very poor at executing. So always always understand those elements of analyzing companies that, even though they may sound attractive on the surface, always do some deep dives. And that made me sort of go into 2020 with a refined strategy to an extent, focusing more on actually putting down what I call the DG engine down over companies that I find interesting. I spend quite a bit of time on sort of screening the market, but what I actually do the most is that I see other people, sources of inspiration, communicate about companies, about stocks that they find extremely interesting, and then I do due diligence on those companies, those stocks, together with my own screening of the market. And the companies that I find attractive are the ones that will end up in my portfolio. And those sources of inspiration come from different places. It comes from Mads Christiansen regarding tech companies, e-commerce companies. It comes from Nasdaq, who's extremely good at stock picking, mining companies. So it really comes from venture capitalists that I follow that are mostly in the VC startup space, but also have some investing in companies that are listed. For instance, Mike Vestergaard, who is extremely bullish on Kahoot, extremely good VC guy as well, but have found the edge of actually doing the same analysis on listed companies. And I think finding those sources of inspiration will take you a lifetime, really. It's all about finding a network of people, and it takes time. It takes time for sure, and also is about testing different people. And a good example are some of the most prominent people on FinTwit, Zach Morris, Hugh Hanna, some of these guys with more than 100,000 followers, Stock Sniper, so on and so forth. These guys are there for the quick buck. Often, Zach Morris is probably more of a swing trader, but these guys have more than 100,000 followers on Twitter, and what that does to them is that they're able to create a bubble or hype around specific stocks. And again, sources of inspiration, fine. If you analyze these companies and you find them to be attractive, then completely agree, fine, invest in them. I've done that with Zach as well, both with IPOC. I was in there before him then, actually, but also with, for instance, Fubo. He saw Fubo at $9, went to $60, a 500% return, which is amazing. So find those sources of inspiration, and I did that, and sort of had built a sufficient network when I went into 2020, and that also made me a significant return in 2020, and I think it will also provide me with a significant return in 2021. What happened in the end of 2020 was that I started managing capital for other people as well. So I've managed my own portfolio throughout the last, I think, 3 years or so, and have created a return of more than 600% in the last 2 years on my own portfolio. But I started managing, apart from my family's capital, I started managing a couple of portfolios in the end of 2020, and that just professionalized my setup even further, sort of both in terms of tracking and monitoring my portfolio, creating a DD engine that's bulletproof, creating a strategy that will avoid emotions but also be robust on a longer period of time. And I think building that robust strategy is difficult, and you will experience over a lifetime in the stock market that there will be drawdowns. What is really the thing is that everybody can really make a sufficient return in an upwards market, an upwards trajectory of the market. We saw that in 2020, and I think what you will see right now on Twitter, for instance, is people that think they are God. God is because they made a return that outperformed the market in 2020. But if you were in tech companies, for instance, you easily outperformed S&P 500 or even the C25 index in Denmark. But the thing is that if you're able to minimize your loss, your drawdown in bear markets, so let's say the IT bubble in 2000, 2001, the financial crisis in 27, the COVID-19 crisis in 2020, sort of these events, these major catalysts throughout the market history, being able to minimize the drawdown in those periods, or even hedge yourself into a state where you can outperform indices in the drawdown period as well as outperform the market in the upwards trajectory. That is where you want to go. And I think that is something I will continuously develop going into 2021 also, as I manage several portfolios now. And that also, when you're looking at my portfolio overview, what you will see is that I may have an extensive number of companies in my portfolio. The reason for that being is that I'm not sort of across the portfolios I manage, it's not one-to-one. And that means that what seems that I have 20-25 companies in my portfolio is actually not the case. So that is actually sort of the background, my story, how I ended up where I am, sort of not reading any books, not seeing any podcasts, simply learned by doing, becoming an autodidact, making analysis, journaling, which is an extremely undervalued element of this, is, and what I also use my Twitter for, is to journal all of my decision making, so that every time you make a buy, every time you make a sell, you're able to actually rationally argue to yourself why you did that specific sort of buy or sell. And I think I ended up where I am without any help, really. The market has helped me become where I am today, and I don't want to make myself anything I'm not. I'm a 23-year-old guy that is still in the early stages of his investment career, and sort of transitioning into the latter focus of this video being motivation and the end game, really. So in 2018, actually when I was a quite significant part of Millionærklubben, I made a decision that sort of started blossoming in during high school, and when I started on Copenhagen Business School reading International Business Bachelor. Sort of, I wanted to become the next Jordan Belfort on Wall Street, right? So the classical dream of becoming a trader on Wall Street or in London, and then becoming a sort of a super capitalist with an extreme amount of money, right? But actually in 2018 that changed significantly after I read a book by Karen Ho called Liquidated, if I remember correctly, that sort of from an ethnographic perspective analyzes the culture on Wall Street. If you haven't read that book, do yourself a favor and do that, because it also provides you with an understanding of what are the dynamics of the market behind the curtains. But that sort of made me pull back from the dream of becoming a trader, and now I'm in management consulting, and that's fine. But again, back to the why and the motivation of actually being invested in the market. And I think there's the classical why, so to say, about I want to increase my wealth, I want to invest my money. There's no alternatives to the stock market, really, if you want to grow your capital, because the interest rates are zero, right, and you don't get anything from having them in bonds or even in the bank in a bank account, right? So, and I understand that's fine, and I think if that is your primary motivation, my probably the best recommendation would be to simply go passive, invest in ETFs or invest in some of these indices that you can follow quite one-to-one in terms of their performance. However, if you have a greater why of simply doing that, then you're able to do what I do. Sort of my interest from the stock market is twofold, really. Of course, I want to grow my capital, I want to grow my own wealth, and sort of create a situation for myself where I'm able to buy the apartment I'm living in. That has already happened. Buy a house at some point, go on vacation, stuff like that, that provides you with freedom and flexibility. But I also wanted to increase my knowledge about capital markets and sort of about companies really. What I do for a living is analyzing companies and doing due diligence, just really providing people or providing companies with a strategy, having a sort of a foreseeing outlook of the future, right? So providing myself with this sort of knowledge from the stock market and capital markets are extremely valuable in my day job as well. But I can't really run away from the fact that I want to live of this one day. And it's not going to be in investment banking, that's for sure. That's not really my turf, I think, also because I like the sort of the unlisted or the non-listed company space as well. Venture capital and private equity is extremely interesting as well. But the end game is probably to create a hedge fund. Guns capital will likely be a thing at some point in the future, and sort of starting up by managing portfolios already now is the first step in that journey, I think, because sort of the last 5 years can be seen as the early stage of that journey, really sort of getting all of the mistakes made early on, losing money, feeling the emotions on your own body, and sort of learning from them, sort of putting that behind yourself, creating a strategy, trying stuff, trying to follow people, trying to blindly follow guys on Twitter and buy whatever they're recommending you to buy, losing money on that once again. So sort of the classical roller coaster ride, really. And I think those 5 years have been extremely learningful for that experience, really, and then sort of getting to where I am right now, where I feel that my strategy is nowhere near done. I won't be done any time in my career, really. I think it will just move on and become more and more robust, really. I'm in a place right now where I feel comfortable investing more and more money in the market. Around 60% of my sort of my salary after expenses, after taxes, are invested in the market, and I feel quite comfortable doing that, also investing other people's money, because I feel comfortable regarding the strategy, really. And sort of in the coming years also having in mind that I think we will see a large correction or even a crisis in the market within the next 3 to 5 years, really. It's also about going into the next phase, really, and what I talked about with drawdowns and being able to outperform the markets in a bear market, because we will end up in a place where we will see a large correction. I think it will be in the size of what we saw back in March 2020. It may even be larger, really, because it may be a huge crisis we're looking into with monetary policies being run right now. But sort of preparing myself for that and learning from that. I think I have several learnings from the 2020 crisis and huge dip in the market, but also want to learn from a longer term bear market that I think we will likely see next time. The crisis in 2020 crisis was extremely accelerated, and it was during 1 month we lost 40% of the market value, really. At least in Europe, right? I think it was a bit only 30%, 35% in US, really. So sort of getting to increase again the learning curve in those environments as well is something I really look forward to in the coming years. And looking 5 or 10 years ahead, hopefully I will be able to start my own hedge fund. I think we will look into a future where quantitative trading and investing will be a bigger part of how we will perceive the stock market. We can already see it right now. Algorithms are taking a greater share of the market, really, and sort of I think the price action in the market back in March 2020 was the ultimate sign that algorithms are all over the place, and algorithms together with the human emotion of panic is probably the worst cocktail ever, and that was what we saw back in March 2020. But I think a larger part of the future will be quantitative. So my hedge fund will likely be a split between the quantitative part of it, building an algorithm. I can't do that at all, so I'll have some people do that for me. But building an algorithm and a system that can outperform the market based on some specific rules, signals in the market that I don't know yet what should be, and then sort of the other part of it being my qualitative, fundamental perspective and approach to the market is likely what I'm looking into. And then if I can sort of do that together with investing in VC startups, scale-ups on the side of that, I think I'm probably in a sweet spot, because I can be exposed to the financial markets and apply all of the learnings that I have really, at that point in time, it will likely be 10 or 15 years that I have sort of analyzed and followed the markets quite intensely. And this process that I have initiated now with YouTube and Twitter and sort of building a brand, but also journaling really, and I think that's what it's all about journaling and then getting things down on paper and getting things down on video like here, where you're able to actually just empty your brain and empty your perspectives on specific things, and those learnings are invaluable really. They are priceless, and I think it's probably a recommendation and an advice to all of you guys that journaling your journey on the stock market is an extremely valuable thing to do, because this journey won't be linear. This journey won't be upwards only as it was in 2020. This will be filled with days like I had this Friday where my portfolio went down 6%. It is an extremely volatile journey, and you need to be aware of that. And if you're not able to sort of get that into your head and be able to put the emotions and sort of the feelings down and away from yourself, I think it will be a tough journey really. I've had periods in my life throughout the last 5 years where I've just sit in the corner and cried my eyes out, because it was so tough, it was so hard, also because I managed my family's capital at the time. Just the feeling of disappointment and sort of not understanding the market is so tough, because you're trying to really crack that nut, but it just won't open really. And I think also those times are extremely valuable. And I think coming down to the why and your motivation of investing, what is it you want to get from this? If it's simply a matter of increasing your wealth, put your money in an ETF following the market, because the market is rising 7% in average over the course of a lifetime. We've seen that throughout the last 200 years, and that's a fact. Of course, nothing is really certain in the future, but if that is your primary goal, then I think stock picking and sort of trying to spend a lot of time in the market is not really worth it. However, if you want to build a really robust strategy where you can increase your wealth while also learning a lot that you can either apply in your daily life, you can apply in discussions with friends or relatives, then I think you're on a good path here. And I think it is really a journey, and even in the tough times, you need to keep your head in the game and keep your nose down. Really keep your head down, and then just focus on the prize, focus on the goal, because there will be tough times. There will be times where you will lose money every single day, and you will be frustrated. You will really think about whether it's worth it. But after 5.5 years in the market, I think I've come to a place now where I can tolerate those ups and downs. I feel comfortable, and also to as large extent as possible, I'm building a strategy that is robust enough to keep myself out of emotions, really, because I have, throughout the last many years in the market, I have made so many bad decisions, both from selling in panic, from jumping back and forth between positions, selling at all-time lows, buying shitty companies, following people blindly, and you just need to get those in the book, really, and sort of learn from your mistakes. And if you're able to get to a place where you're able to do that, I think you're really good off, and I think you will do very well in the market. So to summarize this, what ended up being a very long video, 41 minutes as we speak, this was really a monologue about my background and how I ended up in the stock market and how I ended up in the position I'm in right now. It was a bit of a mixed box, so to say, of advice and recommendations, also providing you with an insight into how I ended up being where I am, but also providing you with a sneak peek into the future, a sneak peek into the goals, and potentially the end game. And I think one thing you will learn is that things are never as they look. So I think my journey has changed and changed direction several times on the way, and what I'm saying in this video right now will likely be changed in 1 year, maybe in 3 years, maybe in 5 years, but I think what is certain is that things are changing as we move along, and as we're living in a dynamic environment. And I think also being able to act in that environment and being able to learn and develop in that environment is a really learningful experience along the way. So hopefully this gave you some sort of inspiration, and you can use this in some sort of way. Otherwise, at least it provided you with an insight into who I am and how I ended up being where I am. Being a 23-year-old guy that is nothing but that has a love for the stock market and capital markets, financial markets, and simply trying to build the most robust strategy and engine, DG engine, really, to be able to find all the red flags before investing in companies, and sort of making mostly good decisions, but also avoiding all the bad decisions, avoiding all of the extremely dangerous emotions that are out there. So thank you guys for listening. This was my 7th video in sort of the sequence, and as always, please go and like and subscribe if you would like to see more of these videos, and also have a look at my Twitter, where I'll post tweets, threads quite often regarding specific companies in my portfolio, but also talking about educational stuff, some of my learnings, and really trying to provide you with the best possible elements and tools to go out there and do what I'm doing myself. So thank you for listening in, and have a good one.